Welcome to the deep dive. Today we're pulling up a stack of some really fascinating source materials, articles, research notes, you name it, to really plunge into a world that's just absolutely crucial for understanding global business, international taxation.
Yeah, it really is. We're going to look at how companies and governments too sort of grapple with this mind-bending challenge of taxing income when it hops across borders.
And specifically how the U.S. system fits into all that, how it interacts with operations all over the world.
Exactly. And our goal here, in this deep dive is basically to be your guides through these materials. We want to pull out the most important nuggets, the key insights, so you can really see the fundamental concepts, the core rules, without getting totally bogged down in the complexity.
Think of it as your shortcut, maybe. A way to get up to speed on something that honestly touches every single multinational company out there.
Right?
Because let's face it, as soon as you have companies that are related, part of the same big corporate family, operating in different countries,
Mhm.
a really fundamental question pops up.
Yeah.
How do you figure out where the money they make together should actually be taxed? And, how do you do that fairly, or at least in a way everyone agrees to live with?
Yeah, that's the million-dollar question, sometimes literally.
Mm.
The sources really get into some, sometimes surprising ways this plays out.
Okay, so let's not waste any time. Let's jump right in.
Let's do it.
All right, so this first big challenge the sources really hammer home, it revolves around something called transfer pricing, specifically within what they call affiliated groups.
Right. So picture a big business operating in multiple countries. It's usually not just one single company, right? It's often a parent company with various subsidiaries, maybe branches in different places.
And these different parts of the same family, they inevitably do business with each other. One sells goods to another, maybe one provides services or licenses technology.
All the time. And the core issue the source points out is this. When two unrelated companies make a deal, the market, supply and demand, dictates the price. But when two companies owned by the same parent make a deal, what the source calls a controlled transaction, well, they could theoretically set any price they want.
And that opens the door for potential game playing, right?
Exactly.
Yeah.
The motivation, as the source highlights, is often tax. It's pretty straightforward.
Yeah.
If you can set a low price when your subsidiary in a high-tax country sells something to your other subsidiary in a low-tax country, you can effectively shift the profit out of that high-tax place and into the low-tax one.
Reducing the company's overall global tax bill.
Bingo.
The source gives this great, simple example, makes it really clear. Imagine a holding company based here in the U.S. It owns 3 subsidiaries in different countries.
Okay.
First, there's M Company. They're a manufacturer located in country M, which has a nice low income tax rate, let's say 10%.
Got it. Low-tax manufacturing.
Then there's W Company, a wholesaler, maybe a distributor. They're in country W, which has a medium tax rate, say 20%.
Okay, middle ground.
And finally, R Company. They're the retailer located right here in the U.S., which for this example has a higher tax rate. Let's call it 30%.
Manufacturer, low tax. Wholesaler, medium tax. Retailer, high tax.
Yeah.
Makes sense. Right. And let's keep it simple. M Company makes a widget, costs them $1 to produce. R Company, the U.S. retailer, eventually sells that widget to the final customer for $9.
So the total profit the group makes on this widget is $8. $9 sale price minus the $1 cost.
Exactly. Now, here's the kicker the source explains. To minimize taxes, the group's ideal scenario, their dream outcome, is for that entire $8 profit to show up on the books of M Company back in country M. Why? Because the tax rate there is only 10%.
An $8 profit tax at 10%. That's only $0.80 in tax, compared to what it would be if that profit landed in the U.S. at 30%.
Precisely. Much less tax overall.
So the source then shows how they might try to engineer this using those internal prices, the transfer prices. M Company, the manufacturer in low tax M, sells the widget to W Company in medium tax W, but they sell it for a high price, say $9.
Okay, selling high internally.
Then W Company turns around and sells that same widget to R Company, the retailer in the high tax US, also for a high price, like $9.
Oh.
And finally, R Company sells it to the actual customer for $9.
All right, let's follow the money, see where the profit lands according to these prices. R Company, the U.S. retailer, they have $9 in sales revenue. But their cost of goods sold, what they supposedly pay W Company, is also $9.
So their profit is $0.
$0 reported profit for R Company in the U.S. Now look at W Company in country W. They also report $9 in sales from selling to R. But their cost of goods sold is $9 too, what they paid M Company.
So 0 profit for them as well.
Yep. Zero profit reported in country W. Where did that $8 of actual real profit go? It all landed with M Company back in country M. They sold the widget for $9, but it only cost them $1 to make. Boom. $8 profit reported right there.
Okay, now this is where it gets really interesting, like you said, because the source points out Country M is probably pretty happy getting taxed on that $8 profit.
Hmm.
But the tax authorities in Country W, and especially the IRS here in the US, they'd look at this and say, hang on a second,
Uh,
not so fast.
oh.
Because even though the final sale, the one to the real customer, happened in the US, and presumably the value is being realized in the US market.
Our company, the U.S. entity, is reporting zero profit, paying zero U.S. tax on that $8 global profit.
And Country W isn't getting anything either, despite W Company's role. All the profit got shifted purely through pricing to low-tax Country M, and the source stresses this isn't necessarily about, like, outright fraud. It's about whether the income reported in each country clearly reflects the economic activity happening there. So the IRS isn't just going to accept this. What can they do? The source points straight to the tax code, IRC Section 482, and also mentions 66662E3 related to penalties. But 482 sounds like the big one.
Oh, it is. Section 482 is like the IRS's main tool, their superpower, you could say, in this whole transfer pricing game. It gives the IRS the authority to distribute, apportion, or allocate. Basically, they can adjust income, deductions, credits, whatever, between businesses that are owned or controlled by the same interests.
So they can step in and change the numbers the companies reported.
Yes. And the source makes it clear, this power is granted for two main reasons. To prevent tax evasion, sure, but also critically just to clearly reflect the income of each related company, and it applies super broadly. Doesn't matter if the businesses are corporations or not, U.S.-based or foreign, or even if they file a consolidated tax return together.
So back to our widget example.
The IRS, using Section 482, would almost certainly look at our company's $9 cost of goods sold and say, no way. They'd argue $9 isn't an arm's length price for a widget that only cost $1 to make, especially when the whole structure seems designed to shift profit. They'd reduce R's COGS to something lower, something they deem arm's length.
Which would mean our company suddenly does have a profit in the U.S.
Exactly, forcing R to report taxable profit and pay U.S. income tax on it.
Okay, to really get this, the source defines some key terms we need to know.
Yeah, these are fundamental for Section 482. First, a controlled taxpayer. That's basically any two or more taxpayers, could be companies, individuals, whatever, that are owned or controlled directly or indirectly by the same interests. Our M, W, and R companies are all controlled taxpayers because the holding company owns them.
Got it. And a controlled transaction.
That's any deal between members of the same controlled group. So M selling the widget to W, that's a controlled transaction. W selling to R, also controlled.
Okay. And the opposite is uncontrolled.
Right. An uncontrolled taxpayer or uncontrolled transaction involves parties who are not related, not controlled by the same interests, just regular market transactions.
And that leads to the uncontrolled comparable. That's the benchmark.
Exactly. It's that uncontrolled transaction or maybe an uncontrolled company doing similar things that you use as a comparison point. It helps you figure out what the result should have been in your controlled transaction if the parties had been unrelated.
Which brings us to the core principle underlying all of this, the arm's length standard.
Yes. The source is really clear. The true taxable income from a controlled transaction must be based on this standard. What it means basically is the results of deals between related companies should look just like the results you'd expect if completely unrelated companies had done the exact same deal under the exact same circumstances.
You have to pretend your sibling company is a stranger you met on the street and price things accordingly.
Pretty much. You have to ask, what would the market price have been?
That makes sense conceptually. But, in reality, finding an identical transaction between unrelated parties, especially for unique products or services or valuable patents, that seems really hard. How do companies or the IRS figure out the arm's length price when a perfect comparison doesn't exist?
That's a huge challenge, and it's where these applicable pricing methodologies come in. The source lists the main methods the IRS accepts. These are the tools you use to estimate that arm's length result.
Okay, what are the main ones?
For selling tangible goods, like our widgets, the preferred method is often the comparable uncontrolled price, CUP method. You try to find sales of the same or very similar goods between unrelated parties, like comparing the price an automaker charges its own dealership versus an independent dealership for the exact same car model. Sometimes you can even use public market data if it exists.
Okay, CUP for goods. What about intangibles like patents or trademarks?
The equivalent there is the comparable uncontrolled transaction, CUT method. You look for licenses or sales of similar intangible property between unrelated parties and compare the royalty rates or prices.
Right. What else?
Also for tangible goods, the source mentions the resale price method and the cost plus method. Resale price is often used by distributors' affiliates that buy goods and resell them without adding a ton of value. You look at the gross profit margin they earn compared to uncontrolled distributors doing similar things.
And cost plus.
That's often used by manufacturers. It looks at the markup over their production costs. You compare the manufacturer's gross profit markup to the markups earned by comparable uncontrolled manufacturers.
Okay, those seem focused on the price or margin of a specific transaction. What about the last one mentioned, CPM?
Yes, the comparable profits method, CPM. This one's a bit different and very widely used. Instead of focusing just on the price of one transaction, it looks at the overall profitability of one of the controlled companies involved in the transactions.
How does that work?
You compare things like the operating profit margin, or return on assets, or return on capital of your controlled company, to the profitability of comparable uncontrolled companies that perform similar functions and take on similar risks. If your company's profitability falls within a reasonable range, the arm's length range of what those comparable independent companies are achieving, then your underlying transaction prices are generally considered to be arm's length.
So it's less about the price of one widget and more about whether the whole entity is making a profit level consistent with independent companies doing similar work.
Exactly. It's often used when good CUP or CUT data is hard to find.
So companies use these methods, document their analysis. When does the IRS tend to really zoom in on transfer pricing? What triggers their scrutiny?
The source lists a few key situations, basically points where income can most easily leak across borders.
Makes sense.
First, anytime a U.S. taxpayer is involved in transactions, buying, selling, leasing, licensing with an affiliate that is not subject to U.S. tax or isn't filing a consolidated U.S. return. Think U.S. parents selling to a foreign sub or vice versa.
Right, the cross-border stuff.
Second, when a U.S. taxpayer has loan agreements or service contracts with these foreign affiliates. If the U.S. parent lends money to a foreign sub, the interest rate needs to be arm's length. If the parent provides management services, the fee needs to be arm's length.
Okay.
And third, when U.S. taxpayers share costs with foreign affiliates, things like R&D costs or maybe centralized HR or IT costs. The way those costs are allocated has to be arm's length too. The affiliate getting the benefit needs to pay its fair share.
These all sound like areas where you could potentially tweak numbers to shift income or deductions around.
Precisely. They are natural focal points for IRS review.
And the IRS's power here under Section 482, it goes beyond just adjusting the income number for that year, right?
Right. Yeah, the source notes they can also adjust the tax basis of assets involved. And in some cases, they can even force a taxpayer to recognize income on a transaction that would normally be tax-free under other rules, like a like-kind exchange, if it's part of a broader scheme that doesn't meet the arm's length standard.
Wow, that seems incredibly powerful. Are there limits? How can a company push back if the IRS challenges their pricing?
It is broad, and like we said, the source emphasizes the IRS can make adjustments even if there was no intent to evade tax. Just not being arm's length is enough. But companies do have defenses. The key one the source mentions is showing that their results fall within an arm's length range.
Okay, the range from the CPM method.
It can be from CPM or CUP or another method, but the point is you typically need to find two or more good uncontrolled comparable transactions or companies, analyze them using one consistent pricing method, and if your company's result, price, margin, profit level, falls within the range of results derived from those comparables, you have a strong case that your pricing is arm's length, even if it's not exactly the midpoint.
So documentation and good comparable data are crucial for defense. What if a company realizes before the IRS shows up that their pricing wasn't quite right? Can they fix it themselves?
They can, but there's a catch. The source says a controlled taxpayer can report prices on their timely filed original tax return that are different from what they actually charged internally if those reported prices better reflect an arm's length result, sometimes called a compensating adjustment.
So you can true things up when you file?
Yes, proactively.
Yeah.
However, the source specifically says you cannot make these kinds of adjustments on an untimely filed return or on an amended return if the effect would be to decrease your taxable income. You might be able to amend to pay more tax, but generally not less based on a retroactive transfer pricing adjustment.
Ah, okay. Encourages getting it right the first time. What
Yeah.
about penalties? If the IRS does make a big adjustment, is it just about paying the extra tax plus interest?
Unfortunately, no. There can be hefty penalties, called valuation misstatement penalties. The source mentions two levels: substantial misstatements and gross misstatements, triggered if the net Section 482 adjustment blows past certain dollar thresholds or percentages of your revenue. These penalties can really add up, sometimes 20% or even 40% of the understated tax.
Ouch. How do companies avoid those penalties?
The best defense, according to the source, is preparing what's called a Section 482 study, or transfer pricing documentation. This has to be done before you file your tax return. It's a detailed report that lays out your intercompany transactions, identifies the comparables you used, explains the pricing method you chose and why, shows your analysis, and concludes that your results are arm's length.
So having that contemporaneous documentation is key.
Absolutely. The source notes that if you use one of the standard methods from the regulations, like CUP, CPM, etc., you generally just need to show your application was reasonable. If you use some other non-standard method, you have a higher bar. You have to prove why the standard methods didn't work and why your method does clearly reflect income.
Is there any way out of penalties if the transaction was just between two foreign subsidiaries?
Yes, the source mentions an exception. Penalties generally don't apply to transactions solely between foreign corporations unless that transaction somehow affects income that's sourced to the U.S. or connected to a U.S. business.
It sounds like getting transfer pricing right involves a ton of work, analysis, documentation. And even then, you might satisfy the IRS, but what if the tax authority in, say, country W, in our example, disagrees and makes their own adjustment? You could end up taxed twice on the same income.
That is a very real risk and a major headache for multinationals. It's called double taxation. When that happens, the source explains, companies can request help from the competent authority.
What's that?
That's the official body within each country's tax administration, like a specific office within the IRS, that's authorized to deal with tax treaty issues. Through the competent authority process, the tax officials from the two countries involved will talk to each other, review the case, and try to negotiate a mutual agreement on what the correct arm's-length price should be based on their tax treaty. The goal is to eliminate that double taxation.
So it's like government-to-government negotiation to resolve the dispute. Is there a way to avoid getting into that situation in the first place, a more proactive approach?
Yes, definitely. That's the Advanced Pricing Agreement Program, or APA program, now part of what the IRS calls APMA, Advanced Pricing and Mutual Agreement. The source describes APAs as agreements made before the transactions happen,
An agreement between who?
between the taxpayer and the IRS. And often, crucially, it also involves the tax authority of the other country, or countries involved. Those are called bilateral or multilateral APAs. They agree in advance on the transfer pricing method, the comparables, the adjustments, the whole framework for how the company's future intercompany transactions will be priced and tested.
So you work it all out with the tax authorities beforehand to get certainty.
Exactly. It locks in the methodology for a set period, typically 5 years. The source lists the kinds of things they agree on, the method, the specific comparables, how to analyze them, how to construct the arm's length range, how to test the company's actual results each year against that range, and any critical assumptions about the business that need to hold true. It provides certainty and avoids future disputes and potential double tax on those covered transactions.
It sounds like a lot of upfront effort, but probably worth it for complex, high-volume transactions.
For many large companies, absolutely. It reduces risks significantly. Sometimes, the source notes reaching an APA involves some pragmatic compromises if there are multiple, potentially reasonable ways to approach the pricing.
Wow. Okay, so that's a whole world unto itself, just figuring out the price between related companies. It's way more involved than just picking a number.
Absolutely. It's one of the most contested areas in international tax for a reason.
Okay, let's shift gears then. We've talked about pricing within the group. Now let's talk about the income itself. Once it's generated, how do you figure out which country actually gets the first bite at taxing it? The sources call this sourcing of income.
Right. Sourcing rules are fundamental. They determine whether a particular item of income is considered U.S. source or foreign source. And this distinction, as the source explains, is critical. For foreign companies or individuals, it generally determines if they owe U.S. tax at all. For U.S. companies and individuals, it's essential for calculating how much foreign tax credit they can claim against their U.S. tax liability.
The source lists, I think, 9 types of income and the U.S. sourcing rules for them. Let's not go through all 9, but maybe hit the big ones and use that M&E core example the source provided. That seemed helpful.
Yeah, the example is great. The main categories mentioned are things like interest, dividends, personal services income, rents and royalties, gains from selling real estate, gains from selling inventory, insurance income, social security, and guarantees.
Okay, so M&E Corp. It's a U.S. company, operations in the U.S. and France. Let's look at their income streams from the example. First up, $5,000 dividend from B Corp., another U.S. corporation.
Okay, dividends. The general rule, per the source, is that the source of a dividend is the country where the paying corporation is incorporated or resides. B Corp is a U.S. corporation, so that $5,000 dividend. U.S. source income. Simple enough.
All right. Next, M&E Corp. gets $10,000 in interest. It's from a loan they made to their French subsidiary, F Corp.
Interest income. The source says the rule here is generally based on the residence or location of the payer of the interest. F Corp is in France, so the $10,000 interest payment from them is foreign source income.
Okay, payer's location for interest. They also got $17,000 in interest, this time from a loan to their U.S. subsidiary, U Corp.
Same rule applies. U Corp is located in the U.S., so that $17,000 in interest is U.S. source income. See how it flips based on who's paying?
Yep, clear. Now, rental income. M&E got $29,000 for renting out property they own in South Carolina. The interesting part is the rent was paid by their French subsidiary, F Corp.
Ah, this one's different. The source clarifies. For rent from tangible property, like a building, the source is determined by where the property is physically located. The property is in South Carolina, USA. Doesn't matter that the tenant paying the rent is French. That $29,000 is U.S. source income. Location of the asset rules here.
Okay, location of the tangible asset. And they also got $36,000 in rent, this time for property they own in Nice, France. And this rent was paid by their U.S. subsidiary, U Corp.
Same rule again. Where's the property? Nice, France. So even though the payer is a U.S. company, that $36,000 rent is foreign source income.
Got it. Location, location, location for tangible property rent. Lastly, they got $43,000 in royalty income, paid by the French sub, F Corp, for using an M&E patent.
Yep.
And the source says the patent is used in France.
Royalties for intangible property, like patents, copyrights, trademarks. The source rule here is where the intangible property is used. The patent is used in France. Therefore, the $43,000 royalty payment is foreign source income.
Wow. Okay. So just to recap that example, dividend from U.S. Corp, U.S. source, payer location. Interest from French sub, foreign source, payer location. Interest from U.S. sub, U.S. source, payer location. Rent from U.S. property paid by French sub, U.S. source property location. Rent from French property paid by U.S. sub, foreign source property location. Royalty for French use paid by French sub, foreign source, place of use.
You nailed it. Different rules for different income types.
And the example totals it up. M&E has $51,000 in U.S. source income, $5K dividend plus $17K interest plus $29K rent, and $89,000 in foreign source income, $10K interest plus $36K rent plus $43K royalty.
Exactly. And remember, this is just gross income sourcing. The next step, which the source mentions but doesn't detail in the example, is allocating expenses and deductions against these U.S. and foreign income buckets to get to taxable income for each. That's crucial for things like the foreign tax credit limit.
Right, that makes sense. The source also touches on how a U.S. company might set up shop overseas, like structurally. It mentions permanent establishment and the difference between operating as a branch versus a subsidiary.
Yeah, that's important too. Permanent establishment, or PE, is usually a concept defined in tax treaties. It's basically a threshold if your business activities in another country reach a certain level of permanence, like having a fixed place of business, a branch office, a factory. It creates a PE. And having a PE generally gives that foreign country the right to tax the profits your business earns there, attributable to that PE.
And for the U.S. parent company, does it matter for U.S. tax whether that foreign operation is just a direct branch of the U.S. company or a separate, legally incorporated foreign subsidiary?
Oh, hugely different treatment, and the source lays it out clearly.
Well, so.
Okay, a foreign branch. Think of it as just an extension of the U.S. company, not a separate legal entity. The big consequence. The branch's profits and losses are taxed currently in the U.S. The income flows right onto the U.S. parent's tax return in the year it's earned.
So no U.S. tax deferral on branch profit.
Correct. But the flip side, which can be good, is that if the branch has losses, those losses can often be used immediately to offset the U.S. parent's other income, including U.S. source income. That's a current tax benefit. And of course, the U.S. parent can claim foreign tax credits for taxes paid to the foreign country on the branch's profits. Moving money back from the branch isn't usually a separate U.S. tax event, since it was already taxed.
Okay, so current tax, potential loss offset. What about a foreign subsidiary?
That's a whole different animal. It's a separate legal entity, incorporated into the laws of the foreign country. Historically, the big advantage was deferral. The sub's active business income generally wasn't taxed by the U.S. until the subsidiary actually paid a dividend back to the U.S. parent. This gave the parent control over timing U.S. tax.
But losses are different.
Right. Losses of a foreign subsidiary generally get trapped in that entity. They cannot be used by the U.S. parent to offset U.S. income. Also, because it's a separate entity, any transactions between the parent and the sub, selling goods, services, loans, must follow those arm's-length transfer pricing rules we talked about. And as we'll get into, the ability to defer tax on subsidiary income has been significantly cut back by anti-deferral rules.
So branch means current U.S. tax, maybe immediate loss use. Subsidiary means potential deferral on some income, but losses are stuck, and transfer pricing is critical. Big strategic choice there.
Huge. It affects U.S. tax, foreign tax, legal liability, everything.
Okay, let's pull back for a second. The source describes the overall U.S. system, calls it primarily worldwide.
That's the traditional label. It means the U.S. taxes its citizens and residents, including U.S. companies, on their income from all sources everywhere in the world. Doesn't matter if it's earned in Ohio or Osaka.
But it contrasts that with a territorial system.
Right. A pure territorial system only taxes income earned inside that country's borders. The source notes most other developed countries, OECD countries, use some form of territorial system.
And the source says the U.S. actually moved towards territorial with the Tax Cuts and Jobs Act, TCJA, in 2017.
It did. TCJA didn't make the U.S. fully territorial, but it introduced major territorial features. The biggest one is that 100% dividends received deduction, DRD, for certain foreign source dividends coming back to U.S. corporations from their foreign subsidiaries. That effectively exempts that income from U.S. tax when repatriated. So now we have more of a hybrid system.
Got it. A mix of worldwide and territorial principles now. And under the worldwide part, you still have that double tax problem. Foreign country taxes it, U.S. taxes it too.
Yep. And the main way the U.S. deals with that, as the source explains, is the foreign tax credit, FTC.
Allowing a credit for taxes paid to other governments.
Exactly. It's a dollar-for-dollar reduction in your U.S. tax liability, up to a limit, for the foreign income taxes you paid on your foreign source income.
Up to a limit. That sounds important. You can't just credit unlimited foreign taxes against your U.S. bill.
No way. The source is clear. The FTC is limited to prevent you from using high foreign taxes to wipe out the U.S. tax you owe on your U.S. source income. The credit is capped at the amount of U.S. tax that's attributable only to your foreign source income.
And the source gives the formula for that limit.
It does. It's your pre-credit U.S. tax liability on your total worldwide taxable income, multiplied by a fraction. The fraction is foreign source taxable income divided by total taxable income, both U.S. and foreign.
So basically, it's the proportion of your income that's foreign times your total U.S. tax.
That's the essence of it. It calculates the maximum U.S. tax you would have paid on just your foreign income based on your overall average U.S. tax rate. Your credit can't exceed that amount. If your foreign tax rate was actually higher than your average U.S. rate, you'll likely end up with excess foreign tax credits that you couldn't use in that year.
Can you do anything with those excess credits?
Yeah, generally you can carry them back 1 year and forward 10 years to potentially use them in years where you have more FTC limitation available.
Okay, but here's a complexity the source flags. You don't just calculate one overall limit for all your foreign income. You have to use separate baskets.
Ah, yes, the FTC baskets. This is crucial. It's an anti-abuse rule. Without it, companies could easily average things out. Imagine a company pays really high taxes, say 50% on its active business income in Germany, but pays 0% tax on some passive interest income earned in the Cayman Islands. Without baskets, they could use the excess credits from the high-tax German income, credits above the U.S. rate, to completely shield the zero-tax Cayman income from any U.S. tax. The baskets stop that. You have to calculate the FTC limit separately for different categories of income.
What are the main baskets the source mentions?
The key ones listed are passive category income. Think dividends, interest, rents, royalties, annuities, typical investment income, often lightly taxed abroad. General category income. This is kind of the default for active business income that doesn't fit elsewhere. Foreign branch income. Income specifically earned through a foreign branch operation. And global intangible low-taxed income, GLTI, that new TCJA category we'll get to, which has its own basket.
So you run that limitation formula separately for the income in each basket.
Exactly. You figure the limit for your passive income, then separately for your general income, and so on. The credit you can actually claim for the income in a specific basket is the lesser of the foreign taxes you paid on that income,
Mm.
or the FTC limit calculated for that basket.
And your total FTC for the year is just the sum of the allowed credits from all the baskets.
That's the process. The source also clarifies what foreign taxes even count generally, income taxes, or taxes paid in lieu of income taxes, not things like sales tax, VAT, property tax.
Yeah.
And U.S. companies use Form 1118 to claim the credit. Individuals use Form 1116. Plus, you can always choose to just deduct foreign income taxes instead, but the credit is usually much better.
Okay, so FTC is the main relief valve for double tax under the worldwide part, complicated by these baskets. Now let's compare that to the territorial piece from TCJA, the participation exemption, or the DRD.
Right, the 100% dividends received deduction. This is the mechanism that makes part of the system act territorially.
Hmm.
Instead of taxing the foreign income and then giving a credit, a participation exemption just exempts the income from tax altogether when it comes home.
So the U.S. version, the 100% DRD, it does this for dividends.
Yes, specifically for the foreign source portion of dividends received by a U.S. corporation from a foreign corporation where the U.S. corp owns 10% or more of the stock. The U.S. corporation gets to deduct 100% of that dividend amount.
And the source says, unlike the FTC, where you might still owe some U.S. tax if the foreign rate was low, with this DRD, there's no residual tax imposed. It comes back completely tax-free to the U.S. corporation.
That's the idea for qualifying dividends, a very different outcome than running it through the FTC calculation.
Who gets this benefit? Just any U.S. owner with 10%?
No, the source is specific. It's only for U.S. corporations owning 10% or more. If you're an individual or a partnership, even if you own 10% or more, you don't get this 100% DRD.
Okay, only U.S. C Corp. Are there other catches, exceptions?
Yes, important ones the source points out. First, you can't double dip. You don't get an FTC or a deduction for foreign taxes paid on the income that generated that 100% deductible dividend.
Yeah.
Makes sense, right? No U.S. tax, no credit for foreign tax.
Right.
Second, there's a holding period. The U.S. core has to have held the foreign core stock for more than 365 days within a specific 731-day window around the dividend date. Prevents buying stock just to get a tax-free dividend and selling it right after.
Okay, anti-churning rule.
And third, and this is key, certain types of income, even if paid as a dividend from a 10% owned foreign core, are not eligible for the DRD. This includes earnings that were already taxed by the U.S. under the anti-deferral rules, things like Subpart F income, GILTI income, or income invested in U.S. property. Also, income hit by that one-time transition tax.
Ah, so if the U.S. already taxed those earnings when they were earned by the foreign sub, you don't get a 100% deduction when they're later paid out as a dividend. That prevents a double benefit.
Exactly. The DRD is primarily for repatriating those foreign earnings that were successfully deferred from U.S. tax until distribution.
Okay, that clarifies the role of the DRD in the post-TCJA world. Let's dive into those anti-deferral rules more now. We're talking outbound transactions, U.S. folks investing abroad.
Right. And historically, as the source mentions, the U.S. did allow deferral of U.S. tax on active business income earned by foreign subsidiaries. Keep the profits reinvested overseas, no U.S. tax until you bring it home.
Yeah.
Helped U.S. companies compete, arguably.
But, like we said, that creates the incentive to just park profits, especially mobile profits like investment income, in low-tax havens indefinitely, hence the anti-deferral rules.
Precisely. These rules override deferral for certain types of income or certain types of structures. The source highlights two main regimes here, the Passive Foreign Investment Company, PFIC rules, and the Controlled Foreign Corporation, CFC rules, which include Subpart F and the newer GILTI.
Okay, what's a PFIC? Sounds passive.
It is. A foreign corporation gets tagged as a PFIC if it meets either an income test or an asset test based on passivity. The income test, 75% or more of its gross income is passive. Dividends, interest, royalties, etc. The asset test, 50% or more of its assets are held to produce passive income.
So basically a foreign investment fund or holding company.
Often, yes. And if a U.S. person owns shares in a PFIC, the source says they're hit with rules designed to eliminate that deferral benefit. Usually means current tax or an interest charge on deferred taxes when distributions happen. It gets complicated fast, with different methods like QEF or mark-to-market.
Okay, so PFIC targets passive investment vehicles. What about the CFC rules? The source says these often override PFIC if both apply.
Right. A foreign corporation is a controlled foreign corporation, CFC, if U.S. persons who are significant shareholders collectively own a majority of it. Specifically, if U.S. shareholders own more than 50% of the stock, by vote or value.
And who counts as a U.S. shareholder for this
A
test?
U.S. shareholder is any U.S. person, could be a company, an individual, a trust, who owns at least 10% of the foreign corporation's stock, vote, or value. So you look only at the 10% or greater U.S. owners, and if they collectively own more than 50%, it's a CFC.
The source has example 1 for this. Let's use it. ABC Corp., U.S., owns 12% of foreign core D. 6 other unrelated U.S. persons each own 10%. The rest, 28%, is owned by foreigners. Is D a CFC?
Let's check. We only count the U.S. shareholders, 10% plus owners. ABC owns 12%, so they count. The 6 other U.S. persons each own 10%, so they count too. Add them up. 12% plus 6, 10% plus 60% is more than 50%. Since 72% is more than 50%, yes, foreign core D is a CFC.
The example also says D gets 80% of its income from passive sources, so it's also a PFIC.
Right, but the source says when it's both, and you're a 10% plus U.S. shareholder like ABC, the CSC rules, subpart FGLATI, generally trump the PFIC rules. So ABC has to worry about the CFC rules for its share of D's income.
Okay, so CFC status depends on 50% control by 10% plus U.S. owners. And the main anti-deferral punch from being a CFC comes from subpart F income. What is that?
Subpart F income is the specific type of CFC income that gets taxed currently to the U.S. shareholders, even if the CFC doesn't pay it out as a dividend. The source calls it highly mobile income, or bad income, the kind that's easy to shift artificially to low tax places.
What kind of income falls into subpart F, specifically the main part, foreign-based company income?
It's generally stuff like passive income, similar to the PFIC definition: dividends, interest, royalties, rents, a list from an active business, etc. Basically, investment-type income earned by the CFC, certain sales income, income from buying goods from a related party and selling them outside the CFC's country, or buying for a related party outside the country. Think using a Swiss CFC just as a sales hub for goods made in Germany and sold in France. Certain services income. Income from performing services for a related party, but performed outside the country where the CFC is incorporated. Think using an Irish CFC to bill for services actually performed by engineers in the U.S.
So it's targeting passive income and income from transactions that seem designed to route sales or services through a low-tax entity that isn't really adding much value there.
That's the idea. And the source is clear. If CFC earns this subpart F income, the 10% plus U.S. shareholders include their share of it in their U.S. income right now. No deferral, and no 100% DRD when that money eventually comes out as a dividend because it's already taxed.
Okay, subpart F stops deferral on passive and certain related party active income. Then TCJA added GILTI, Global Intangible Low-Taxed Income. What's this about?
GILTI is another whack at anti-deferral, effective from 2018. The source explains it's basically a minimum tax on the earnings of CFCs that aren't already caught by subpart F, especially if those earnings are taxed at a low rate overseas. It's aimed squarely at profits derived from intangible assets, patents, brands, know-how, because those are seen as the most easily shifted to low-tax jurisdictions.
A minimum tax on intangible income sitting offshore. How do you calculate it? The source has example 2 seems involved.
It is a bit. Conceptually, you take the CFC's net income, after taking out subpart F income and a few other things, and then you subtract a deemed normal return on the CFC's tangible physical assets. Whatever profit is left over is potentially GILTI.
Why subtract a return on tangible assets?
The idea baked into the formula is that a certain return, the source says 10%, on physical assets like factories and equipment is a normal return on tangible investment. Profit above that level is presumed to be generated by mobile intangible assets, and that's the income GILTI targets if it's not being taxed much abroad.
Okay, let's try example 2. Hughes Corp US owns 15% of EKM Corp, a CFC. EKM's net income is $1.5 million. First, we need that return on tangible assets.
Right. The source says we need EKM's average adjusted basis in its depreciable tangible property. It gives the quarterly numbers: $1, $25, $1, 2 shifal bets, $1.15.
So the average is $1 plus $1.25 plus 1.225 minutes plus $1.15 summers 4 second. Carry the 1 equals $1,156,250.
Perfect. Now, the deemed return on that tangible property is 10%. So 10% of $1,115,250 minus this carve-out, $115,625.
Correct. We found $500,000, $115,625 minus this carve-out, $115,625 base. And Hughes Corp owning 15% has to include 15% of that in its U.S. income.
It's exactly. 15% of $1,384,375 is $207,656 rentals. That amount flows onto Hughes Corp's U.S. tax return currently, just like subpart F.
Is there any special deduction or credit for GILTI? It sounds like it could be a big hit.
Yes, for U.S. corporations like Hughes, there's a significant deduction. The source says it's 50% of the GILTI inclusion amount for years before 2026, then it drops to 37.5%.
So in the example, Hughes gets a deduction of 50% of $207,656, which is $103,828.
Right, and the source notes that this 50% deduction, combined with the fact that corporations can generally claim an FTC for 80% of the foreign taxes paid on that GILTI income, was designed to result in an effective U.S. tax rate on GILTI of around 10.5% before 2026. So it's not the full 21% corporate rate, but it is a minimum tax designed to discourage profit shifting to zero tax locations.
Okay, so Subpart F hits passive mobile income, GILTI hits the low-taxed excess return over tangible assets. Are there other ways CFC earnings get taxed currently?
Yes, one more big one. Earnings invested in U.S. property. The source explains this rule stops companies from getting cash out of their CFCs tax-free by disguising distributions as something else, like a loan back to the U.S. parent or having the CFC buy U.S. assets.
So if the CFC uses its untaxed foreign earnings to invest back into the U.S., that triggers tax.
Pretty much. If a CFC increases its investment in certain U.S. property, its U.S. shareholders are taxed currently on their share of that increase, up to the amount of the CFC's earnings that haven't already been taxed under Subpart F or GILTI.
What counts as U.S. property here?
The source lists things like tangible property physically located in the U.S., stock in a U.S. company, loans or obligations of a U.S. person, this is a big one, or rights to use U.S. patents or copyrights in the U.S.
Example 3 uses the loan scenario.
Okay, example 3. Bluecor, a CFC, loans $1 million to its U.S. parent company in Q2. The loan stays out all year. How does this work? The rule looks at the average amount of U.S. property the CFC holds during the year, based on quarter-end balances. In the example, assuming no prior U.S. property, the balances are Q1, $0, Q2, $1, make Q3, $1, Q4, $1. The average is $0 plus $1 plus $1 plus $1 for $750,000.
So the increase in U.S. property investment is $750,000.
Right, assuming zero at the start of the year. That $750,000 is treated as a deemed dividend to the U.S. shareholders and taxed currently, assuming Blue Corp has at least $750,000 in earnings that haven't already been taxed. It stops companies from just loaning money back instead of paying taxable dividends.
Okay, so Subpart F, GILTI, U.S. property investment, multiple ways the U.S. taxes CFC earnings before they're actually distributed. What happens when that money is finally paid out later as a dividend?
Good question. That's where previously taxed income, PTI, comes in. The source explains that when a CFC distributes earnings that have already been included in the income of its U.S. shareholders under Subpart F, GILTI, or the U.S. property rules, those distributions are generally received tax-free by the shareholders.
Avoids taxing the same dollar twice.
Exactly. There are complex ordering rules for tracking which earnings come out first. But the principle is, once taxed, not taxed again on distribution.
All right, shifting slightly, but still under TCJA, that one-time transition tax, Section 965, what was that about again?
That was a huge deal back in 2017. Remember how companies had deferred U.S. tax on tons of foreign earnings accumulated over decades in their CFCs? As the U.S. shifted towards the 100% DRD for future dividends, Congress decided to impose a one-time tax on all those past, untaxed accumulated earnings sitting offshore as of late 2017.
A deemed repatriation, like forcing them to bring it all back for tax purposes, even if the cash didn't move.
Exactly. It applied to 10% plus U.S. shareholders of CFCs.
How was it taxed? Was it all at the regular rate?
No, they set two special lower rates. The portion of the untaxed earnings held as cash or cash equivalents was taxed at 15.5%. The rest of the earnings, like those reinvested in factories, etc., were taxed at 8.0%. And the source mentions taxpayers could elect to pay this tax liability over 8 years, with smaller payments up front, 8% per year for 5 years, and bigger ones later, 15%, 20%, 25%.
Must have been a massive calculation for many companies. Okay, another TCJA creation mentioned is BEAT, Base Erosion and Anti-Abuse Tax. Sounds aggressive.
It's aimed at preventing large U.S. corporations from stripping earnings out of the U.S. tax base by making deductible payments to their foreign affiliates. The source says it applies to companies with average annual gross receipts of $500 million or more.
So big companies paying interest, royalties, service fees, etc. to their foreign-related companies.
Exactly. Those payments reduce U.S. taxable income. That's the base erosion. BEAT acts as a minimum tax to ensure these companies still pay some U.S. tax despite those deductions.
How does it work?
You calculate the company's taxable income, but then you add back most of those deductible payments made to foreign affiliates to get modified taxable income. You calculate a tax on that modified base, using the beat rate.
And the rate is?
The source gives the schedule. 5% in 2018, 10% from 2019 through 2025, and then it dumps to 12.5% after 2025. BEAT only applies if this calculation results in a tax higher than the company's regular tax liability after credits, and if those base erosion payments exceed a certain percentage threshold of total deductions, usually 3% or 10% depending.
So it's a backstop, ensuring large corps pay a minimum tax even if they have significant deductible payments going offshore. Does it apply to everyone?
No, the source says it doesn't hit individuals, S-Corp, R8Cs, or REITs, primarily large C corporations, and there are anti-abuse rules too.
Okay. Now, are there any tax rules designed to help U.S. companies that are exporting? Incentives?
Yes. TCJA also introduced the FDII deduction, Foreign-Derived Intangible Income. This is a deduction for U.S. corporations aimed at encouraging them to earn income from export activities related to their intangible property from the U.S., rather than holding those intangibles offshore.
What kind of export income qualifies for FDII?
The source lists things like income from selling property to foreign persons for use outside the U.S., income from providing services to foreign persons or related to property outside the U.S., and income from selling to a related foreign party who then sells it on for foreign use. Basically, income derived from serving foreign markets from the U.S.
And the deduction is significant.
It is. For C-Corp, not RICS REITs, the source says the deduction is 37.5% of their FDII before 2026, dropping to 21.875% after. This basically gives that export-related intangible income a lower effective U.S. tax rate, around 13.125% initially.
So an incentive to generate IP income here and sell license abroad. Is there anything else for exporters? The source mentions something older, an ICDISC.
Ah, yes, the Interest Charged Domestic International Sales Corporation. That's been around a while. It's a special type of U.S. corporation that's usually tax-exempt itself. It's used by U.S. manufacturers or distributors who export goods made in the U.S.
How does it provide a benefit?
The exporting U.S. company pays a commission to the ICDISC based on its export sales. The exporter gets to deduct that commission, reducing its regular corporate income. The ICDISC receives the commission tax-free. Then, when the ICDISC eventually pays dividends to its shareholders, usually the same owners as the exporter, those dividends are taxed at the lower qualified dividend rates instead of ordinary income rates.
So it converts some ordinary income from exports into lower tax dividend income for the owners.
That's the core benefit. The source notes that there are limits on how big the commission can be, generally the greater of 50% of the net income from the export sales or 4% of the gross receipts. It's basically a tax subsidy for exporting U.S. goods.
Wow, okay. That covers a ton on the outbound side: anti-deferral, base protection, export incentives. The summary table in the source is definitely helpful for keeping track of all those acronyms: Subpart F, GILTI, BEAT, FDII, ICDISC.
It's a very complex web, showing that constant tension between encouraging global business and protecting the U.S. tax base.
All right, let's flip the script completely now. Let's talk inbound transactions. This is when foreign persons, non-U.S. individuals, foreign companies, etc., invest or operate here in the United States.
Right, the general rule.
Yeah.
The U.S. taxes foreign persons on their income from U.S. sources. The source breaks this down into two main categories: how their business income is taxed versus their non-business income.
Okay, how does the U.S. tax a foreign person's U.S. business income?
If a foreign person is engaged in a trade or business in the United States, then the income that is effectively connected with that U.S. business, often called ECI, is taxed on a net basis.
Net basis meaning?
Meaning they get to deduct the expenses associated with generating that income, just like a U.S. business would. The resulting net profit is then taxed at the regular U.S. graduated tax rates, corporate rates, if it's a foreign company operating through a U.S. branch, individual rates if it's a non-resident alien individual actively conducting business here.
Example 4 in the source uses British Bunting Inc., a U.K. company with a U.S. branch selling stuff.
Yeah, good example. The branch has a $100 gross profit, $40 cost of goods sold. Because making routine sales is a U.S. trade or business, the income is ECI. So British Bunting is taxed on the net income of $60, $140 at U.S. corporate rates. They'd file a Form 1120-F to report this.
And the source contrasts this with using a U.S. subsidiary.
Right. If they'd formed a U.S. subsidiary instead, that sub would just be a regular U.S. corporation, filing Form 1120 and paying tax on its worldwide income, though likely only U.S. income in this simple case. The branch is taxed only on its ECI.
Okay, so ECI gets taxed net at regular rates. What about the other category, non-business income?
This is usually passive investment-type income from U.S. sources, things like dividends paid by U.S. companies, interest from U.S. borrowers, royalties for U.S. use, some rents that is not connected to a U.S. trade or business. This type of income is taxed very differently on a gross basis.
Gross basis, meaning no deductions allowed.
Exactly. No deductions against it, and it's
Yeah.
taxed at a flat statutory rate of 30%.
30% on the gross amount. How does the IRS make sure they collect that, especially from someone living overseas?
Through withholding. The source explains the main system here is the FDAP withholding regime.
FDAP, fixed determinable annual or periodic income. Catchy.
Yeah. It basically covers those types of passive income.
Hmm.
The rule is the U.S. person paying the U.S. source FDAT income, like the U.S. company paying a dividend or the U.S. borrower paying interest, to a foreign person is legally required to withhold 30% of that payment and send it directly to the IRS.
So the payer acts as the tax collector.
Correct. It ensures the tax is captured before the money leaves the U.S. Now, critically, as the source mentions, tax treaties can often reduce that 30% rate, sometimes dramatically down to 15%, 10%, 5%, or even 0% for interest or royalties under many treaties. But the starting point is 30% withholding by the U.S. payer.
The source also mentions FACA withholding. Is that the same thing?
Similar mechanism withholding, but totally different purpose and target, as the source explains. FACA, the Foreign Account Tax Compliance Act, isn't primarily about taxing the foreign person's income. It's about combating tax evasion by U.S. persons using foreign accounts.
How does withholding help with that?
FACA imposes a 30% withholding tax on certain U.S. source payments made to foreign financial institutions, banks, brokers, funds, and certain other foreign entities, unless those foreign entities comply with FACA rules. Those rules require them to identify their U.S. account holders or owners and report that information to the IRS or their own government.
So FACA withholding is like a penalty on foreign banks or entities if they don't cooperate in reporting on U.S. persons.
Exactly. It pressures them to provide transparency about U.S. assets held abroad. FDAP withholding taxes in the income, going to the foreign person. Evasia withholding penalizes non-compliant foreign intermediaries. Different goals.
Got it. That's a key distinction. Now, what about foreign individuals? Can someone who isn't a U.S. citizen or a green card holder end up being treated like a U.S. resident for tax purposes, meaning they get taxed on their worldwide income?
Yes, absolutely. This catches a lot of people by surprise.
Yeah.
Even if you don't have a green card, you can be considered a U.S. resident for tax purposes based purely on how much time you spend physically present in the U.S.
The source gives two tests for residency. One is the green card test.
That one's simple. If you have a green card, you're a lawful permanent resident. You're generally a U.S. resident for tax purposes.
The other is the substantial presence test. This is the one based on days.
Yes. This test has two parts, both of which you need to meet for the current year. 1. You must be physically present in the U.S. for at least 31 days during the current calendar year. 2. You must meet a 183-day threshold calculated over a 3-year look-back period using a weighted average.
Okay, how does that weighted average work? It's not just 183 days in 1 year.
Right. For the 183-day test, you count all the days you were present in the U.S. in the current year, plus 13 of the days you were present in the first preceding year, plus 16 of the days you were present in the second preceding year. If that weighted total adds up to 183 days or more and you met the 31-day test for the current year, then bam, you were treated as a U.S. resident for tax purposes for the entire current year.
Example 5 in the source walks through this. Esther from the UK. She's in the U.S. for 122 days in year 1, 122 days in year 2, and 122 days in year 3. Is she a resident in year 3?
Let's do the math. First, was she here 31 days in year 3? Yes, 122 days. Okay.
Yeah.
Now, the weighted average for the 3-year period ending in year 3. Year 3 days. 122 1Cs equals 122 year 2 days. 122 13 equals 40.67 year 1 days. 122 16 total weighted days equals 122 plus 40.67 plus 20.33 equals 183 days exactly.
So she hits 183 on the nose.
Yep. Since the total is 183 or more, she meets the substantial presence test for year 3. She's a U.S. tax resident for year 3, subject to tax on her worldwide income, even though she was only here for about 4 months that year.
That's huge. Just spending around 120 days a year consistently can tip you into U.S. residency.
It's a critical calculation for frequent visitors or snowbirds. The source also briefly mentions a first-year election, where someone can sometimes elect to be treated as a resident for part of their arrival year if they meet certain conditions and will meet the substantial presence test the next year.
Okay, so inbound tax depends on whether income is business, ECI, TaxNet, or non-business, FDAP, taxed gross via withholding. And individuals need to watch their days carefully to avoid accidentally becoming U.S. residents via the substantial presence test.
That sums up the key inbound issues nicely.
Now, what about the opposite? People or companies trying to leave the U.S. tax system, expatriation.
Right. The U.S. has rules for that, too, often called an exit tax, particularly for individuals. It applies to covered expatriates.
Who gets covered?
The source says you're a covered expatriate if you renounce U.S. citizenship or if you're a long-term resident ending residency, and you meet any one of three tests on your departure date. 1. Tax liability test. Your average annual net income tax over the prior 5 years was above a certain threshold. It's $190K for 2023, indexed for inflation. 2. Net worth test. Your net worth is $2 million or more. 3. Compliance test. You can't certify that you've been fully compliant with U.S. tax obligations for the past 5 years.
So, high income, high net worth, or non-compliant, you're likely covered. What's the tax consequence, this mark-to-market thing?
Yes, it's a big one. The source explains that if you're a covered expatriate, the law pretends you sold all your worldwide assets for their fair market value on the day before you expatriated.
Ouch. A deemed sale of everything.
Everything, worldwide. Any gain resulting from that deemed sale is generally recognized and taxed in your final U.S. tax year.
Is there any relief? Like an exemption amount?
Yes, thankfully. There's a significant exclusion amount that reduces the taxable gain. The source puts it at $821,000 for 2023, also indexed. So you only pay tax on the deemed gain above that exclusion amount. And you can sometimes elect to defer the tax payment on certain assets, but you usually have to post security and pay interest.
Example 6 makes this real. Kathleen, U.S. citizen, net worth $7 million, mostly stock with a basis of only $250K. She renounces citizenship in 2023.
Okay, first, is she covered? Her net worth is $7, which is way over the $2 threshold. So yeah, she's a covered expatriate. Now, mark to market. Her stock is deemed sold for $7 the day before she leaves.
Game is $7 minus her $250K basis. $6,750,000.
Right. But then she gets to subtract the 2023 exclusion amount, $821,000. So her taxable gain from the deemed sale is $6,750,000. $821,000 is $5,929,000. That's treated as long-term capital gain, taxed in her final U.S. tax year, a very substantial exit tax.
Definitely deters high net worth individuals from just walking away. What about companies doing this, those corporate inversions, where a U.S. company flips its structure to have a foreign parent?
Right, expatriated entities. Historically, this was done to lower taxes, maybe access foreign cash easier. The U.S. has rules to discourage this too, and the impact depends heavily on how much stock the original U.S. shareholders still own in the new foreign parent after the deal.
What are the key ownership levels?
The source lays out two main scenarios. If the former U.S. shareholders end up owning 80% or more of the new foreign parent, the tax code basically ignores the inversion. It treats the new foreign parent as if it were still a U.S. corporation for all U.S. tax purposes. So no tax benefit achieved. If they own 60% or more, but less than 80%, the inversion is respected. The parent is foreign. Vopiti, the source says this group gets penalized. They're generally blocked from using U.S. tax attributes like NOLs or FTCs to offset any gain recognized because of the inversion transaction itself, inversion gain.
And TCJA added more hurdles.
Yes. The source notes TCJA made inversions even less appealing. For instance, dividends paid by these inverted surrogate foreign corporations back to their U.S. CCs. Corporate owners are not eligible for the 100% DRD, and individual shareholders don't get the lower qualified dividend rates on those dividends either. Takes away some key benefits they might have been seeking.
So whether you're an individual or a corporation, the U.S. tax system has significant tolls and barriers if you try to formally exit it.
That's definitely the takeaway from the source material. They want to prevent erosion of the tax base.
Okay, one last major piece the source mentions, tax treaties. How do these fit into everything we've discussed?
Tax treaties are incredibly important. They are bilateral agreements negotiated between the U.S. and other individual countries. The source says the U.S. has them with about 60 countries. And crucially, under U.S. law, these treaties have the same legal force as the Internal Revenue Code itself. They often modify or even override the standard U.S. tax rules for residents of the treaty partner country.
So you can't just look at the U.S. tax code in isolation if a treaty might apply.
Absolutely not. You must check the treaty. The source highlights the common ways treaties change things. They almost always reduce that 30% U.S. withholding tax, the FDAP tax, on things like dividends, interest, and royalties paid to residents of the treaty country. Rates often drop to 15%, 5%, even 0%. They provide specific definitions of permanent establishment, PE, which determine when one country can tax the business profits of a resident of the other country. They have rules to resolve situations where both countries might claim someone is a resident, tiebreaker rules, or where the countries have conflicting rules for sourcing income. And they contain provisions for that competent authority process we talked about, allowing the governments to resolve disputes and exchange tax information.
So treaties add complexity, but they often work to reduce taxes, especially withholding taxes, and prevent double taxation between the two partner countries.
That's generally their purpose, to facilitate cross-border trade and investment by providing clearer rules and mitigating double tax while also preventing tax evasion. If a treaty applies, its terms are paramount.
We have covered a lot of ground today, really guided by these source materials. We went deep into transfer pricing, the arm's length standard, Section 482.
And how the IRS polices those intercompany deals.
Mhm.
Then we tackled sourcing, where income is actually from using that M&E Corp example for dividends, interest, rent, royalties.
And the different rules for each. Plus, the key distinction between operating overseas as a branch versus a subsidiary.
Then we got into the big U.S. systems,
Mhm.
the anti-deferral rules like
Mhm.
Subpart F and GILTI, hitting that foreign income currently.
The mechanisms to avoid double tax, like the foreign tax credit with its complex baskets, and that newer 100% DRD, the participation exemption.
How the U.S. taxes inbound investment, distinguishing ECI from FTAP, the withholding rules, those tricky residency tests for individuals based on physical presence.
And finally, the expatriation rules, the exit tax for individuals, and the anti-inversion rules for corporations, plus the overlay of tax treaties.
It's a massive interconnected system. But understanding those core concepts we pulled from the sources, arm's length, sourcing matters, why anti-deferral exists, how FTC and DRD work differently, the inbound rules, expatriation consequences, it really gives you a solid foundation.
It really does, and it highlights just how much global business is shaped by these national tax policies and how governments are constantly trying to adapt, like all those TCJA changes, to keep up with how companies operate across borders. It's a real cat and mouse game sometimes.
Absolutely. And seeing this constant evolution of the sources, from long-standing principles like arm's length to brand new regimes like GILTI and BEAT, it really makes you wonder, doesn't it? As technology keeps blurring borders, as business becomes even more mobile and digital, how will these international tax systems keep adapting? What new challenges, maybe things we can't even quite imagine yet, will arise in figuring out who taxes what in a truly globalized digital economy? And what kind of innovative solutions might be needed down the road?
That is definitely a lot to think about. The complexity isn't likely to go away anytime soon. Thanks for joining us on this deep dive.